Okay, thank you. Good afternoon, everybody. It's great to be here. I'm Andrew Chesworth, Director of Risk and Return at OFWAT, with the Economic Regulator for the water and wastewater sector in England and Wales. My responsibility at OFWAT relates to the financial aspects of the price controls and the overall balance of risk and return. So my role is to ensure we align the interests of companies and their investors with those of customers. I'm here today to talk about outcomes-focused regulation of the privatised water sector in England and Wales. I'm not here to sell you privatisation. As an economic regulator, we are not a political body. But this talk comes at an interesting time for us at OFWAT. The debate about whether water and sewerage services are best delivered under a private or a nationalised structure is one that is happening right now in the UK. But that is a matter for government. It's a debate that we don't directly contribute to, other than to correct facts where they are wrong. My aim today is to give you a canter through where we've come from, where we are now, and where we are going next. I hope that this will help you to have an informed debate about how water and sewerage services may be delivered here in New Zealand in the future. So the water sector was privatised in 1989. This was for a number of reasons, but principally the public sector-based water boards were underfunded, inefficient and poor performing. They, like other government-funded services, were at the mercy of a politically driven set of decisions. Prior to privatisation, investment in the water sector competed with other pressures from the public purse. So investment was insufficient, rivers and bathing waters were polluted, there was a lack of accountability and transparency. The theory behind privatisation was that shareholders would respond to the incentives they faced to create value, and shareholders would instil private sector management disciplines. To succeed, a robust governance model was required. Separate government bodies, the Drinking Water Inspectorate and the Environment Agency, were set up to determine drinking water and environmental quality standards and held companies to account for compliance against those obligations. OFWAT, the independent economic regulator, was set up to secure that the interests of customers were protected and to incentivise efficiency. It is OFWAT that grants licences and enforces company obligations against those licence requirements. OFWAT is also the competition authority for the water sector. It was envisaged that competition would best serve to align the interests of shareholders and customers, so we were given a specific duty to promote competition where feasible to do so. But the natural monopoly parts of the value chain, so commonly the network, the regulatory framework was set up to make use of comparative competition to secure cost efficiency and deliver service quality to customers. So OFWAT is responsible for setting price controls that include an efficiency challenge. Companies have scope to outperform and reveal new efficiency frontiers. We have powers to take action, including the application of financial penalties where companies do not comply with the terms of their licence. Government is not absent from this governance model, but it operates one step removed. The drinking water and environmental quality regulators enforce government quality objectives, but in common with the other economic regulators, OFWAT is set up as a non-ministerial department. We're independent of day-to-day government intervention, but accountable to Parliament. This, quite reasonably, gives ministers a mechanism to convey their views about what regulators are doing and what they are delivering, while avoiding undermining the benefits of independence from government. Regulatory decisions can be subject to judicial review, and companies can appeal price determinations we set to the Competition and Markets Authority, which has the power to override our decisions. But overall, we are charged with promoting economy and efficiency, driving competition where reasonable to do so, and protecting customers. We rely on the power of financial incentives to align the interests of shareholders and company management with customers, and government is responsible for the wider policy objectives for the environment and drinking water quality. But to a large extent, we are left to just get on with the job. Just briefly, this slide shows the companies we regulate. Today, we regulate 17 regional monopoly companies. 10 of these provide water and sewerage services, 7 provide water-only services. These companies operate under a variety of ownership structures. 3 are listed on the London Stock Exchange. 1, Welsh Water, is a company limited by guarantee under a mutualised structure. The rest are privately owned. We also regulate one infrastructure provider and 9 small monopoly companies, all of which have been granted licenses since privatisation. Earlier this year, we opened the retail market for business customers. This means business customers are able to choose their supplier, and so we currently regulate 24 retailers and 2 self-supply customers under this regime. But this is an area that's evolving, and I'll touch on this later. So the water sector has come a long way in meeting the promise of privatisation. Customer satisfaction stands at around 90%. Environmental quality has been transformed. Despite the dense population, 2/3 of our beaches are classed as having excellent quality, and wildlife is returning to waters previously too polluted. Leaks are down by 1/3. We have a better, more reliable service. Customers are 5 times less likely to suffer supply interruptions. We've had a massive reduction in low pressure. Customers are 100 times less likely to have low pressure today than at privatisation. Drinking water quality stands at 99.96% against national standards, and there's been huge increases in resilience and connectivity of water networks, and huge improvements in the health of the assets. Customers are 8 times less likely to suffer from sewer flooding. And all of this has been delivered at a cost of about £1 a day, so about $2 New Zealand dollars. Average bills are £395 per annum, which I understand is broadly comparable with customers of Watercare in Auckland. And companies are investing around £44 billion every 5 years. Despite all of this, if you look at the chart in the top left, bills today are about the same place as where they were 20 years ago. And we expect bills to decrease. So bills are decreasing by 5% in real terms by 2020, and we see scope for bills to continue to fall by 2020 to 2025. So this is a really good story. And it's all been possible because we have driven almost 150 billion of investment in these services since privatisation, all raised by, and 70 billion of that has been raised from debt and equity investors. And this has been driven by 2 key factors: the independence of the economic regulator, which provides investors with a certain degree of predictability, and the regulatory commitment to the regulatory capital value, which means that investors have have a reasonable degree of certainty that the net value of efficient sunk investment will be remunerated. But this is not a one-way street. We expect companies to deliver for their customers. Companies really feel our regulation where they fall short. And to date, we've reclaimed more than 750 million from companies for customers where companies have fallen short. In England and Wales, companies are free to choose their own corporate structure and make their choices about the proportion of the RCV that is financed by debt and equity. Companies must at all times maintain an investment-grade credit rating. That's essential for them to access the finance they need to deliver services to customers in a cash flow negative industry. But questions do arise about the sustainability of some of the debt structures. It's difficult to see in the chart on the bottom right, but there's some companies that are operating with debt levels of about 80%. This is their choice. We've always been clear that the need for financial structures to be resilient. Where companies fail because of their choice of financial structure, that is a matter for shareholders. Customers should not bail companies out. We're shining a light on this, and we're seeing some companies react and reduce gearing levels in the past year. But as a footnote, I should point out that the regulatory protections have been successful to date. Some of you may remember the failure of Enron. One of the companies we regulate, Wessex Water, was within the Enron group of companies at that time. But the regulatory regime ensured the service to customers was protected through the ensuing sale. But we face new challenges. We don't stand still. Like New Zealand, we face population increases. There's estimates that the population could increase by 20% over the next 20 years, and this will put pressure on water resources in areas such as the dry southeast of England, where resources are already stretched. We are facing predictions of a 20% decrease in summer rainfall and a 20% increase in winter rainfall by 2050. And 1 in 5 customers do not feel that their bills are affordable. In addition, the sector faces an ongoing challenge of legitimacy. The recent Labour manifesto, for example, contains a proposal to renationalise the water sector, along with a number of other sectors. When we last set price summits in 2014, we were conducting some reviews. We concluded that the traditional approach to regulation was not the model that would be fit to deliver the future challenges. The regime that had been placed for the first 20 to 25 years following privatisation was successful in delivering significant efficiencies and improved services to customers. Apologies. But now, more than ever, customer expectations are rising. The products and services they expect are changing, becoming more personalised, more targeted and more reflective of their needs. Regulation needed to adapt, and companies needed to adapt and step up to the mark too. So we started to move away from a prescriptive rules-based regime. We'd conducted a few reviews. We found that companies were placing too much emphasis on the regulator identifying and solving problems. This led to poor accountability amongst companies for their actions and a loss of trust. We wanted companies to focus on what really mattered for customers, rather than report against performance metrics that were derived by the regulator, which were what the regulator thought that customers wanted. This meant a need to really embed customer in the decisions that underpinned companies' business plans. We wanted a system where companies took ownership of their business plans. We wanted companies to seek efficiencies, to be efficient, and give us business plans that did not contain padded cost forecasts. We wanted to push the best performing companies to get even better and push others to do the same. We wanted to shift companies away from a focus on financial engineering to increase focus on what mattered for customers. And we thought that the system we were operating was too administrative. The conclusion of our reviews was that for the sector to be successful in the future, it needed to maintain its legitimacy amongst stakeholders. Legitimacy requires the public to have trust and confidence in water and wastewater services. Trust and confidence is our vision for the sector, and it is why our strategy is called Trust in Water. Now, these high-level conclusions seem fairly obvious. It seems to me they apply whatever ownership structure is used. But they had important ramifications for the way we regulate. So we adapted our approach. First, we adopted an outcomes-focused approach. This means a focus on the things that really matter for customers, the environment and society. We expected business plans to be underpinned by robust customer engagement. Companies were required to put consumer representation groups in place to report to us on the engagement they undertook. And we would step in, where necessary, to protect customers' interests where the engagement fell short. Second, we amended our regulatory approach to ensure our regulation was proportionate and targeted. This means focusing on intervention where it is most needed. In the context of the 2014 price review, we introduced a risk-based review, and this was intended to encourage companies to move away from submitting opening bid draft plans and a second final business plan to submit best offer plans first time. Rather than submitting a padded business plan and aiming to haggle the regulator, companies had one-shot opportunity to demonstrate their plan was in the customer interest. The risk-based review was aimed at stimulating competition to produce business plans. Procedural, reputation and financial rewards were available to companies that provided the best plans and that required no or very minimal intervention from us. This proved to be very successful. Third, we stepped up our focus on assurance by increasing the burden of proof on companies. We introduced a company monitoring framework which set out in the public domain our assessment of the level of assurance we have from each company in the information that it reports. We shine a light where we have less confidence in information reported by companies, stepping in where necessary to protect customers. And fourth, we adopted a more pro-market approach, using markets to align the interests of customers with investors and companies. So we're seeking opportunities to make better use of markets. We also adapted our approach to efficiency. Previously, we've focused on OPEX and CAPEX separately, but we asked we asked companies to give us business plans on a TOTEX basis, which meant that companies had to look for the most efficient solutions on a whole life cost basis. Our approach is already working and helping to address some of the challenges I mentioned earlier. Now, I was asked to talk specifically about the outcomes regulation approach that we adopt. So how do outcomes work? Very simply, we allow companies to recover money from their customers at price reviews. Traditionally, the revenue we allowed companies was focused on the cost of delivering service. At PR14, our aim was to put more revenue at stake for successful failure in provision of services that really mattered to customers. So companies engage with customers on the high-level objectives of what matters to them. Companies propose a number of bespoke performance commitments or pledges that allow them to deliver the outcomes that customers value. These are subject to challenge by customer representation groups, and where these commitments do not look sufficiently challenging, we would step in to get companies to raise the game. The pledges and the rewards or penalties became part of the regulatory contract that is set at each determination, and companies feel the consequence of penalties or rewards for their actual performance. Companies then strive to deliver high-level standards of service, but ultimately this means that companies should deliver the service that customers want and are willing to pay for. Levels of service should improve, and we challenge companies to do more at the next price review. So in summary, outcomes are the high-level objectives valued by customers. Performance commitments are the pledges companies make about those service levels to meet the outcomes, and outcome delivery incentives are the rewards and penalties that encourage companies to deliver their performance commitments. In some of these areas, we can make comparisons across companies. So by making use of comparisons, we can push companies to stretch themselves harder to catch up with the performance of the best. And we learn as we go. For the next price review, we are considering increasing the strength of the rewards for the very best performing companies. This benefits all customers in England and Wales by pushing the very best companies to strive to be even better. There's one example in this slide. So a company might have an outcome. We want secure and reliable water supplies. This outcome will be underpinned by a number of performance commitments. One of these may be related to the length of supply interruptions, with a service pledge linked to the average length of those supply interruptions. Rewards and penalties are set by reference to the service pledge based on an assessment of customers' willingness to pay. Rewards and penalties that can then be totted up at the end of the price control and recovered through higher or lower bills. But outcomes are also useful to deliver wider policy goals. As I've said, we and the companies must be able to trust the information that companies publish. Companies must be transparent about their successes and failures, and transparency about ownership structures and financing arrangements are crucial to maintain legitimacy. Water and wastewater services are vital public services. The bar for legitimacy is high. Arguably, it is higher under a privatised model, and so we expect the companies we regulate to have the highest levels of transparency, meet the highest standards of UK governance and disclosure, and have effective boards containing significant independent membership. Each year, companies must publish the information to show they are meeting our principles, and the quality of companies reporting on how they are meeting the principles forms part of our rating of information quality. Our drive for better quality performance information has led the companies to deliver their own information platform to report performance data. It's a website called Discover Water. But while mechanisms like outcomes are delivering benefits, we know that we need to go further in changing our regulatory approach. We are encouraging companies to engage more than ever before with customers. We expect companies to see customers as active participants rather than end users of services. We expect companies to do more to protect the interests of vulnerable customers, for those who are more sensitive to the requirement for safe and reliable services, or that require help in the payment of their bills. We are seeking opportunities to give customers choice, either directly or through forms of indirect competition, and we are engaging companies to focus on the long term, Companies must already develop their 5-year business plans within the context of 25-year resilience plans, but we are pushing companies harder than ever before to demonstrate their resilience to shocks. And we're continuing a drive for the companies to be more efficient, provide more affordable and sustainable services for the future. We're seeking to ensure the right conditions for customers to deliver innovation, and our focus on innovation is one of the big key themes for PR19. So what does this mean? We will shortly be publishing our methodology for the 2019 price review. This will build on the approaches that underpinned our 2014 review, and they will go much further in some areas. We are further strengthening company ownership of the relationship with customers and the ownership of their plan. We are enabling more effective engagement and challenge by customers and consumer representation groups by improving the availability and quality of data on comparative performance. We expect more stretching outcome performance commitments and more powerful outcome delivery incentives. We are strengthening the efficiency challenge and costs. And by doing all of this, we are further rebalancing returns away from financing out performance to the investor focus to focus on operating the business. We're actively pushing the use of markets in certain parts of the value chain to deliver benefits, and more importantly, send signals in a more dynamic way. So bioresources, which is also known as sludge, produces biogas or green gas. This can be used to generate low-carbon electricity, and many companies are doing that already. When processed, it can be safely used in agriculture as a fertiliser. But this is an area where greater use of markets is possible. It's an area where innovation is ongoing, and we're seeing companies innovate in this area over the last few years, and further efficiencies are possible. But the water and sewage companies are not the only people that can deal with this. Third parties can come in and treat and dispose of sludge. So the introduction of markets could lead the incumbents to seek innovative ways of using existing capacity which will benefit bill payers in the long term. We're encouraging the trading of water resources between companies to enable a movement of water from where it is plentiful to where it is scarce. By ensuring we set the conditions to encourage water companies to trade between themselves and with third parties, we could see smarter use of water reserves in the future. And as part of the same work, we're encouraging the efficient management of supply too, promoting a market to improve demand management and tackle leaks. We're also looking for companies to outsource or directly procure infrastructure projects to third parties. There's no reason why the existing incumbents should be the ones that deliver new infrastructure such as reservoirs or large transfer schemes. It's possible for third parties to come in and deliver those schemes at a lower whole life cost to customers. And as I said earlier, we've already introduced retail competition for business customers in England. The market is developing steadily. The market was opened in April. As of the end of August, 2% of non-household customers had switched supplier. But quite a number of others had renegotiated the terms of supply with their existing suppliers. We've also carried out a review on the potential benefits of extending competition to residential customers. A final decision on that would be one that would be made by government, but if that's the route that government decides to go, it would be for us to make sure that the market is effective. So in summary, the system of privatisation in England and Wales has worked successfully in improving services and prices to customers. But that system has to and is evolving to meet new challenges. It requires the use of new and different tools to ensure the changing needs of customers today and in the future are met. We've made significant progress in moving from a regulator-focused to a customer-focused sector. This requires more than a change in the incentive framework. It requires deep cultural change within the sector. A key success factor is that many companies were keen to embrace this change, albeit after some hesitation. And so the focus on customers, along with the focus on markets and competition, has increased the opportunity as well as the risk facing companies and required them to grapple with how they best meet customer expectations rather than just responding to the regulator. But as I set out at the beginning, the debate about whether the sector should be nationalised is real. The privatised sector has been successful at delivering services improvements at a low cost. We provide the regulatory tools, but companies have the responsibility to really step up, to innovate, and to find new and better ways of doing things. They must ensure customers are engaged and actively involved in the development and delivery of services. And this is necessary if they are to maintain the trust and confidence of their stakeholders. Thank you.